morning. Thank you for joining Armanino today for our webinar entitled Impact of New Lease Standard Accounting Standard, Beyond Your Balance Sheet. So I just want to remind all of our audience members how to use your webinar pane. In the upper right-hand corner of your screen, you'll see a small orange arrow. Click on that orange arrow to expand the screen. And if you have questions for our presenters throughout the PowerPoint presentation, please type them in. We will try to answer questions at the end of the webinar. If we run out of time, we will make sure that we respond to you via email within 48 hours. So make sure that you do send us your questions if you have them as the presentation goes along. Also, make sure that you've got your audio settings set up correctly. If you are using your computer for audio, please select the Use Computer settings. If you're using your phone, make sure you check the phone box. This will help reduce echoing and feedback for you. And finally, to qualify for CPE today, you must make sure that you are using a personal computer and log in with your own information and unique URL. You need to be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of our webinar. Actively respond to at least 75% of the polling questions and complete the evaluation survey at the end of the webinar. So we'll look forward to sending out to you your electronic CPE certificates after you complete all of these requirements. You will also get a link to the slides and a recording of the webinar within 48 hours. So thank you very much for joining us today. My name is Mary Tressel, and now I'd like to introduce our presenters. We have Grant Lamb, a partner here at Armanino, and Justin Wecker. So Grant, please.
Thank you very much, Mary, and hello, everyone. My name is Grant Lamb, and I am an audit partner at Armanino. I've been with the firm for about 15 years, and I'm based out of our San Francisco office. And along with Justin, I help lead our leasing practice. I work with clients in a variety of industries, including clients in the leasing and financial services sector, and I'm very excited to be here today and talk to you all about the new lease accounting standard.
Yeah, good morning, Grant. Thanks for joining me here this morning. Justin Wecker, I'm a director here with Armanino, 20 years into practicing. I actually sit within our CFO advisory practice. We hope to help drive on a number of on our clients' parts how to implement the new lease standards. So happy to be here this morning, and I know we have a lot of content to cover, so let's get started.
Let's jump into it. Okay, so the learning objectives of today's webinar have been classified into 3 key categories. So first, we will review the primary differences between the new lease accounting standard and the current lease accounting standard, and we'll also talk about how the new lease standard interplays with the new revenue recognition guidance. We will then analyze examples of how the new lease standard will be accounted for by a lessee. And we'll talk about this more later, but the new standard has a much greater impact on the lessee than it does a lessor. So we'll focus our discussion on the lessee side of the house. And then we will talk through some actionable steps that your organization should be developing now to prepare for the upcoming standard. And the agenda for today's webinar will follow the learning objectives that we just discussed. So we will start by reviewing the key changes for both lessees and lessors, as well as provide some background as to how the new standard came into existence, and really talk about the objectives and the why as to why the new standard was issued. And then we'll spend a good majority of the webinar analyzing how to apply the new standard. We'll talk about what is considered a lease. The definition of a lease is slightly different now under the new standard. So we'll talk about what is considered a lease. And then we'll talk through the steps that a lessee will take to account for a lease and walk through a good working example. And we will wrap things up by talking through some actionable steps that your organization can be taking and developing now. And we'll also share some topics and some food for thought type discussion points that you as a CFO, a controller, or a finance director should be really thinking about now. And we'll also be sharing some best practices to help you prepare for the new standard. We have a lot of material, as Justin mentioned, so let's jump right into it. So the new lease accounting standards are one of the most significant changes to GAAP to happen in a very long time. The new standard is codified as ASC Topic 842, and it was issued in February of 2016. And the new guidance will replace the current guidance that is in ASC Topic 840. And if it feels like we've been talking about this new lease guidance for a long time, it's because we have. The new guidance has been in the making for about 10 years. And the fact that it's taken so long for this new guidance to be issued really underscores how significant of an impact this guidance will have on the in the accounting industry and really to all organizations that operate under leases. So we're really going through a period now with some pretty significant changes to accounting between this new lease accounting standard and the new revenue recognition guidance. There's a lot of substantial changes to accounting. And we'll talk about this more later, but one of the objectives of the new standard is to align some of the lease accounting concepts with the revenue recognition guidance. But in terms of objectives, the primary objective of the new lease standard really is to increase transparency. So the new, or rather the current lease accounting model garnered a lot of criticism, primarily because minimum lease payments from operating leases were kept off of the balance sheet. So many financial statement users felt that an organization's financial statements did not accurately represent its true leasing obligations. So in the spirit of transparency, the new standard essentially puts all leases onto the balance sheet and expands the disclosure requirements, all with the intention of providing financial statement users with more useful information about an organization's leasing activities.
Yeah, Grant, I think that's a really good lead in, and I would just highlight that for a lot of us who've been living through ASC 606 for the last couple of years and now into leasing as well, these are principle-based standards. So we here in the US, when the IASB and the FASB join together, these are principle-based standards, and that feels strange to a lot of us in the US, right? As we liked our rules, we liked bright lines, and now as we adopt these new standards, they really are principle-based, and we really need to interpret and think through how best to adopt and also draft policies by management within a company to identify our own lines now, and that feels a little different. So we've been doing this quite a lot in 606 world, and as we embark more into the leasing standard now, I think that still holds true. So doing away with the bright lines, and that feels a little strange, but we're gonna help you think through those.
Yeah, I agree. Seems like that seems to be the trend in this all of accounting, where the rules are moving away from really prescriptive rules-based approach to more of a principles-based approach. We evaluate each situation on its facts and circumstances and apply the rules.
Yeah, so we're going to talk about changes for lessees on this slide, specifically, as Grant alluded to, you know, the aha moment for your boards and the thing and your investors, those who go, what is the real impact of ASC 842? Well, historical operating leases for lessees were off balance sheet. Those are coming on, and some people would say, they go, well, if I lease a portion of a building, I now have to put said building on my books. No, you do not, but you do have to recognize a right of use asset. So an ROU, a right of use asset is the standards way of identifying your asset relative to the lease, and of course a corresponding lease liability. But I think it's important to understand the distinction. You're not putting a quote unquote building on your books, you're putting a right of use asset, and that is a key kind of salient point of the standard. The new standard does keep the concept of operating versus capital. We will no longer call it a capital lease. It's now a financing lease, but the standard adopts similar, and we'll go through it in detail, but similar thinking along what is a finance or capital lease.
Okay, so as Justin just highlighted, you can see if you're a lessee, that could be a significant change to your accounting by having to recognize a right of use asset for your operating leases. So while the accounting applied by lessees has significantly changed, the accounting applied by lessor will remain relatively unchanged from current GAAP. So lessors will continue to determine if a lease is a finance or an operating lease. And if you have a finance lease, you would further classify it as sales type or direct financing. And for operating leases, lessors will continue to recognize the underlying asset. And for finance leases, lessors will recognize a lease receivable. So those concepts haven't changed under the new guidance. The new standard does change slightly the classification of what's considered a sales type or a direct financing lease. Under current GAAP, the difference between a sales type lease and a direct finance lease is contingent on whether or not there's upfront profit on the transaction. If there is upfront profit, it's a sales type lease. If not, it's a direct finance lease. The new definition or classification criteria moves away from that concept of upfront profit, and it now looks at whether or not there's third-party guarantees involved in the calculation. So if you do involve third-party guarantees, then it's considered a direct finance lease. If not, it's a sales type lease. Really what this means is we're likely going to see fewer direct finance leases under this new standard. Also under the new standard, we likely will see more initial direct costs. These are IDCs. More of the IDCs may be expensed at lease commencement. So fewer IDCs will qualify for deferral.
And Grant, I noticed on our slide, we don't spell out what an IDC is.
Right.
Incremental direct costs, right?
Right.
And so you were highlighting that under 840 or historical legacy GAAP, a lot more qualified as an IDC than will be under 842, the new GAAP guidance, right?
Exactly. Right.
It's more finite. It's relative to only those truly incremental costs to initiate the lease. Right?
That's right. Examples of IDCs would be commonly we see commissions, or we also see payments that are made to an existing tenant to incentivize the tenant to terminate its lease. So we likely will see more of these costs being expensed up front. Okay.
Yeah, and I think we touched just briefly on the intro in terms of the interplay with ASC 606 or the new revenue standard. We see a lot of overlap in some of the thinking between the two new standards. It certainly is meant to be that way. And so we see, as an example, for a lessor, and we'll get into this later in the presentation in terms of identifying components, lease components and non-lease components, but from a lessor's perspective, how to then allocate the lease payments between those items. It dovetails with the thinking around 606, and those of you who are working your way through that in terms of determining a standalone selling price to prorate and allocate to your performance obligations, same concept. So a lot to be taken from both from 606 that dovetails into 842. I would also highlight that in a number of instances where you have a lease, there is likely a non-lease component that is then subject to 606. Right, so we're thinking maintenance and some of those items. So there is dovetailing that has to happen, and we'll think through transition with you, whereby you might adopt 606 first and then 842 a year later. What we're candidly seeing in a number of our clients, specifically now the private companies, oftentimes they want to do both at the same time. It makes a lot of sense, and that way it avoids kind of a year of confusion where you might delay adopting ASC 842. So definitely seeing a lot of clients and interest in adopting both at the same time.
All right, and now we'll have our first polling question. So please make sure that you give us your response to this question. So what are the objectives for issuing the new lease standard? Is it to improve transparency of leasing transactions, align lease guidance with the new revenue recognition standards, create fewer off-balance sheet leasing transactions, and then all of the above, or you're not sure. So we're looking for each of you to be able to make sure that you put in your vote there. You don't necessarily have to get the right answer. We just want to make sure that you give us an answer, and then Justin and Grant will be sharing the correct answer with all of us. So we're going to give about 15 or 20 more seconds to get all of you to vote. And I also just want to make sure that I let you know we will be sending out copies of the presentation and a link to the recorded webinar within 48 hours of today's presentation. So that will come to you. Okay, at this point, we've got the majority of members who have voted. So we're going to close the poll and share the responses with you. It looks like we had 83% who said all of the above. Is that correct?
And that is the correct answer. We have a very bright audience with us here today. So one of the primary objectives I mentioned earlier is to increase transparency by bringing operating leases on to the balance sheet. And as Justin previously mentioned, quite a bit of crossover between the new lease accounting standard and the new revenue recognition guidance.
All right.
Oops. Okay. So the effective dates are fast approaching, folks. The effective date for public companies is fiscal years beginning after December 15th, 2018. So that means if you are a calendar year end, the new lease standard takes effect on January 1st, 2019. That's only about 5 months or so away from now. And for all other entities, which would include private entities, all nonprofit organizations, the effective date is delayed a year, and it will go into effect for fiscal years beginning after December 15th, 2019. So that effectively would be fiscal 2020 for you calendar year ends. Early adoption is permitted, although I'm not hearing a lot of my clients or clients at all rushing out there to early adopt the new standard. I think they've been pretty focused on the 606 implemented, so I don't have many clients rushing out there to adopt. Have you heard many clients, Justin, rushing out there to early adopt the new standard?
I was actually at in a proposal yesterday talking about early adopting 842 in conjunction with RevRec. I think for the private companies, it makes a lot of sense to do both in terms of a project at the same time. And at least you know what's in front of you, what needs to take place, and then you can be strategic about when you actually want to adopt. But what we're certainly seeing on the CFO advisory side, a large interest from our client base in getting through and helping folks think through 606 and 842 at the same time.
Good.
And I would say, I just want to introduce the concept of an embedded lease, right? You can have a sales contract under 606 that may have an identified asset that is subject to leasing under 842, and that in and of itself is an embedded lease. And it's concepts like that where 606 and 842 dovetail together that it can make a lot of sense to do both simultaneously if you have those types of things. And we'll again talk more about the embedded lease concept, but should not be ignored.
Cool, thank you. Okay, so the new lease standard applies to all leases, including subleases. But based on the definition of what is considered a lease and an asset, certain assets are scoped out of the new lease standard. Specifically, the new lease standard does not apply to the following assets. So it does not apply to leases to explore minerals, oil, natural gas, or other similar natural resources. Does not apply to biological assets such as timber. Assets under construction are scoped out, and as is intangible assets and inventory. I've also been asked whether or not small dollar leases, such as computers or copiers, would be scoped out, and the answer is no. The new guidance does not provide an exception for small dollar leases. Okay, so next we will jump into the next segment of our discussion, and we'll start with the analyzing how to apply the new standard.
Yeah, the new definition of a lease, I'll be reworded, is very similar. A contract or part of a contract, I'll come back to that, or part of a contract that conveys the right to control the use of an identified property, plant, or equipment for a period of time in exchange for consideration. That I think for most people reads pretty straightforward, but a couple points to illustrate. it can be an explicitly or implicitly identifiable asset, right? You might have explicitly would say, this is the asset, here's the serial number. An implicitly specified identified asset would be, it's obvious in the lease that you're talking about this asset, not a basket of assets, but it may not explicitly state a serial number or clearly identify. So the concept is, again, principle-based to capture all if you really truly have an identified asset, and we'll talk more about substantive substitution rights. The second salient point that we want to talk about in terms of the definition, and it's different from old GAAP to new, is this concept of control. And the concept of control, again, we'll step you through what that can mean, but it's over the use of the period of use, right? The old way of thinking was, I have an asset and am I going to use it for 75% of its useful life? Well, now you have to think of it, it may be a 16 or 18 month lease, so greater than 12 months. But if you control it during the period of use, you have yourself a lease. So again, a lot of determination on what constitutes control, and we'll talk more, but I do want to highlight the period of use is a new concept and can really trigger a lot of leases that historically may not have been leases. So don't let this slide scare you. I remember the first time I saw this in the codification. This is the lease decision framework, but it can be a little bit hard to interpret, but I hope to illustrate and give you a visceral example. And so what we have here is these sets of questions do not have to be sequentially answered, but it does have to, it goes to who has control and some of the key questions that you as management will have to ask yourself on whether, one, you have a lease or you do not. And by the way, this concept and questions applies to both lessors and lessees. So let's talk about that. So the first question you would ask yourself in determining do you have a lease is, do you have an identified asset, right? We talked about whether it's implicit or explicit, but do you have an asset identified? And again, scopes out inventory and intangibles and the like. That can be clear. The one thing that's not listed here is this concept of substantive substitution rights. So I'll give you an example. Let's say, for example, I am a company that owns a fleet of private jets, of which I have one jet that's, I'm going to have Grant wants a jet, but I have the idea that I can swap out his jet for any of my other jets in my fleet at any point in time. That is a substantive substitution. And if you can do that and prove that you do that, you may not have a quote unquote identified asset, and therefore do not have a lease. Now, in that example, it's most likely Grant, when he was leasing this, or I'm sorry, entering an arrangement for this private jet, he probably had a specific jet in mind, and you probably do have an identified asset. So the second question, does the customer have the right to obtain substantially all the economic benefit during the period of use? This is another example is a factory. Yes, you have a factory, but the idea of capacity, well, you're going to lease up 20% of said capacity. That is not substantially all the economic benefit of said facility. Now, if you lease, and I use the general term lease up, 100% of said capacity, you most definitely likely have a lease. So this is the same in telecom on, as an example, dark fiber. If you have an identified strand within a fiber that's dedicated, you have a lease. But if the idea is the supplier can toggle your information from one end of the dark fiber to the other, not identifying a simple strand, then you probably don't have this idea of an identified asset, and you're probably not getting all of the capacity and those types of things. So those are another consideration. This concept of the next question, does the customer or the supplier have the right to direct how and for what purpose the identified asset is used throughout the period? A lot of times these arrangements have protective rights. So if I'm providing a jet to Grant, I may not allow him to fly to particular geographies, right? That is me protecting my asset as the lessor. And yes, there is an element of control, but at the same time, if Grant can hop on said jet and determine and tell the pilot wherever he would like to go, it's arguable that Grant has a whole lot more control rather than I do as the supplier, just with protective rights. So those are some of the thought processes on that one as well. The next question, does the customer have the right to operate the asset through the period of use without supplier having the right to change those operating instructions, right? So again, same example with Grant leasing a jet or entering into an arrangement for a jet. If we have a set arrangement up front and I, the supplier, do not have the right to modify it significantly along the way, most likely we do have a lease. Inversely, if I could control it and change the terms of the agreement as the supplier in at my discretion, then it's arguable that I have more control as the lessor, or I'm sorry, as the supplier. So, and then the next question is, did the customer design the asset specifically for the end customer in mind? That almost indefinitely triggers that you do have a lease. If something is built, the old language, built to suit for you, and it cannot be used by another readily, you most likely have, it's been designed for you, you in turn have a lease. So again, the concept of control and over the period of use are key here. And hopefully by the examples that I provided, it can get very confusing and open to interpretation. Who has more control in the relationship, the supplier or the customer? Same concept on the, I enter into arrangement with a private jet and Grant takes said private jet. What if I supply the pilot? What if the supplier provides the pilot? Who then has control? So these are things that we've thought through with a number of our clients, and it can get confusing. And again, principle-based, this is where management needs to make a determination, policy it as such, and move on. I would highlight that you can have the phenomenon where I as a lessor think I have a lease, and the lessee goes through the same criteria and says, no, I don't have a lease, right? So in an ideal world, you'd have visibility. Both the lessor and lessee would agree that, yes, they have a lease and on the type of lease that they have. But it can get into this phenomenon where, the lessor does not think they have a lease and the lessee does, so it doesn't have to be perfect, but certainly can be open to interpretation on this one.
Yeah, this is a good example of the principles-based approach, where it's going to require some discretion and judgment as to whether or not a lease is in place. And I really like Justin's recommendation to have a policy in place to kind of walk through this decision tree, because as Justin mentioned, one of the primary differences under this new standard is the concept of control. That really didn't exist under the current standard or definition of a lease, whereas under the current guidance, you may have a lease without control of the asset. Under the new guidance, you need to have control for it to be a lease. Okay, so here we take a look at a roadmap to account for a lease under the new standard, and the slides that follow will take a deeper dive into each of these steps. So after you've gone through the lease decision tree and you do in fact have determined you do have a lease in place, the first thing to do is to look at the lease term, which begins at lease commencement and extends through the non-cancelable period of the lease. Then you want to determine the lease payments. And when determining the lease payments, you also have to factor in the existence of any lease and non-lease components. You then want to calculate the discount rate, which is used in several of the calculations. And then once you've gathered the aforementioned data points and pieces of information, the next thing you want to do is classify the lease. One thing you'll notice here is we don't refer to as a capital lease, we refer to as a finance lease now. And the classification criteria, for the most part, is very similar to the current standard, but there are some slight changes, which we'll talk about in a minute. And then after classifying the lease, the next step would be to set up the initial measurement and accounting for the lease, followed by subsequently measuring the lease. And Justin's prepared some great examples of the accounting entries to make on day one, followed by the day two accounting, which we'll walk through. in a few slides from now. Again, this is just a high-level overview of the lease accounting steps, and now we'll take a deeper dive into each of these steps. So the lease term. This is a non-cancelable period for which a lessee has a right to use an underlying asset. And we also have to consider the existence of any options that may exist in the lease. And there are both lessee and lessor controlled options. The lessee controlled options generally include options to extend or renew the lease, or options to terminate the lease. And the lessor controlled options generally include options to extend or not to terminate the lease. So these options will be factored into the lease term if it is reasonably certain that the options will be exercised. And reasonably certain means more than probable. It means there's a high likelihood or a high degree of certainty that that event or that option will be exercised.
Yeah, Grant. We've talked to a number of clients that think about the new standard, and we as trained accountants want to think through, maybe we want to beat these rules, so maybe we'll restructure our leases to be 11 months long and with a renewal, but definitely not 12 months in length, and therefore beat the expedient, and we'll just renew and renew and renew. Or even we'll take it a step further and we'll enter into an arrangement that was historically lengthier and make it a monthly type of renewal. Well, this again, being principle based, kind of rules that out, right, Grant?
Right.
If you're reasonably certain and you have to go to your auditors and you constantly renew and you've structured it this way to beat it, it won't work, will it?
It won't work. That's exactly right. We see a fact pattern history of folks renewing their 11-month leases into the 12th month. It's gonna have to be accounted for under the new lease standard. And that takes me to my next point. Lessees are allowed to make an accounting policy election to not recognize lease assets and lease liabilities for any short-term leases of 12 months or less. So all other leases are required to be accounted for as lease assets and liabilities. Okay, so after determining the lease term, we then need to determine the lease payments. And there can be several components to the lease payments as highlighted here on this slide. We start with the fixed payments, which include property taxes and insurance. And think of fixed payments as payments that are unavoidable. These are hard costs that have to be paid. We then could factor in any variable payments that are based on a consumer price index. If there are any lease incentives, these have to be subtracted and removed from the lease calculation. Example of lease incentives are upfront cash payments to the lessee or any other incentives provided to the lessee. These are subtracted from the lease payment calculation. If there's any options and they're reasonably expected to exercise the option, you want to include the option to exercise price in the lease payments. Any payments for early lease termination have to be included. Certain leases may have fees owed to the lessee of a special purpose entity for structuring the transaction. You want to factor in these as well. But as you can see, there's several pieces of or components of a payment that we have to consider when calculating what those lease payments are. And we mentioned earlier, but there could be several components of a contract as well. Specifically, there could be lease and non-lease components. The lease components are essentially the right to use the underlying asset. So for an example, a contract can contain multiple lease components. For instance, you can have a single lease contract to lease pieces of equipment, such as a tractor, a crane, and a bulldozer. So each of the separate vehicles is considered a separate lease component. The non-lease components are the goods and services that are provided by the lessor to the lessee that aren't directly tied to the use of the asset. Examples would be maintenance. Many times we see paper and toner costs and copier leases. We see cleaning services and other type of other goods and services that aren't directly tied to the use of the asset. So if you do have these different components, the requirement is you must bifurcate the components and allocate the price on a standalone price basis, which is the price a customer would pay to acquire these goods and services on a standalone basis. And you would allocate the costs, and costs that are allocated to the lease components are included in the right of use asset and lease liability calculation. Costs allocated to the non-lease components are expensed as incurred.
Yeah, Grant, I just would highlight from the Rev Rec perspective and having helped many clients through that, this same concept that you just spoke about in terms of identifying components and then allocating consideration to each of these. This can be an implementation challenge for organizations, right? Coming up with that thinking, that ability to mechanically approach and bifurcate these components can be a real challenge. And that's certainly what we saw on the 606 side in terms of allocating to performance obligations. So
absolutely
not to be underestimated, this effort, but there are practical expedients we'll get to, but
yep.
Certainly not to be underestimated.
Yep, and that's a great segue because, as Justin mentioned, many companies, after going through 606, may find it difficult to bifurcate the component and allocate the prices. So there is a practical expedient available to allow companies to bundle its lease and non-lease components. So essentially that enables company to not have to go through that allocation process. However, be aware that electing this accounting policy may result in a higher balance to your initial right of use asset and liabilities, because essentially you're including the non-lease components with the lease components. Okay, so next step in the process is to calculate and determine your discount rate. And this discount rate is important because it's used in several of the calculations. For a lessee, the discount rate is a rate that is implicit in the lease, and that rate cannot be readily determined. Lessees can use its incremental borrowing rate. For a lessor, the discount rate is a rate that is implicit in the lease. And the rate implicit in the lease is essentially a calculation where if you apply that rate, it makes the present value of the lease payments and the residual value equal to the fair value of the asset. And the incremental borrowing rate is the estimated rate of interest that a lessee would incur on a similar borrowing in a similar economic environment. To make things even easier for non-public companies, an election is available for non-public companies to use a risk-free discount rate. That's only available to non-public companies. Public companies aren't allowed that use of a risk-free rate. I'm anticipating many of my private companies may elect to use that rate just for ease of not having to calculate the rate implicit in the lease.
Yeah, I would just highlight that I think the governing bodies, FASB and the IASB, have gotten smarter based on experience on Rev Rec. I can tell you a number of large public clients really struggled with this idea of getting an implicit rate or an incremental borrowing rate from a central treasury function, and then having to apply a risk factor to leases that are in, say, a different geography outside of where the treasury function was. And it became a real science and a real challenge for many large public companies. So I think, again, the governing bodies are getting smarter. I think most non-public companies should take them up on this election.
I've tried helping my clients with that rate, and sometimes it can be difficult to determine. Okay, so next we get to lease classification. Under the current lease standard, if you recall, classifying a lease as capital or operating is a big deal because only capital leases made it onto the balance sheet. Under the new standard, since essentially all leases end up on the balance sheet, classifying a lease as finance or operating is not as significant of a deal, but still pretty important because it impacts several of the calculations. So a lease that meets any of the criteria here is considered a finance lease. So if ownership transfers, if a lessee is reasonably certain to exercise a purchase option, if a lease term is for a major part, and I highlight major part, and I'll say why in a minute, of an asset's remaining life, if the present value is substantially all of the fair value of the asset, or if the asset is of such a unique and specialized nature, it really has no other use to the lessor at the end of the lease. If any of these criteria are met, then it's a finance lease. One thing I'll note that's different under this new lease classification is it removes the bright line rules. We all remember the 90% of net present value tests and 75% of useful life tests. Those bright line rules have gone away and been replaced with language that states substantially all of the fair value of the asset or major part of the asset's remaining life. So definitely more of a principles-based approach.
Yeah, I think that's important, Grant. I mean, we certainly didn't want to, the governing bodies did not want answers that did not make sense, and that's the shift to the principle base. They didn't want to make a hard line, bright line rule, and now it's incumbent upon companies to come up with their own bright lines in terms of what does substantially all mean, right? And that feels, again, to my earlier comments at the beginning of the webinar, that feels a little uncomfortable for a lot of us US-based accountants, and that is what is incumbent upon management to do, is come up with their policy position and drafting a policy position on what substantially all means, as an example. Their own bright lines for the company.
Yep, exactly.
All right, and now we're ready with our second polling question. So we are going to ask you here. Okay, so, sorry, it's just coming up here. The non-public companies can use which of the following rates for its discount rate in determining lease calculations? Rate implicit in the lease, incremental borrowing rate, risk-free discount rate, all of the above, or not sure? It's a little complicated. That's a tough question here for our audience. We're making sure you're awake. So we want to make sure that all of you get the chance to vote and get your CPE credit. So please go ahead and if you don't know the answer, you can select not sure. Again, we just want to make sure that this is an opportunity for Grant and Justin to educate our audience. So we're going to keep the poll open for just about 10 more seconds here. Please register a vote. And Grant will let us know the correct answer. So, all right, we will go ahead and close that poll. Thank you. And the most popular answer was all of the above.
And again, that is the correct answer. So non-public companies can elect to use the rate implicit in the lease. If that's not readily determinable, they can use the incremental borrowing rate. And a third option is the risk-free rate. And keep in mind that risk-free rate is not available to public companies.
Yeah, so we have a couple examples that we've prepared from the lessee's perspective. I'll try to go through them fairly quickly. We've got about 15 minutes to the hour, and certainly want to spend some time on actionable steps that we think can get companies going on the standards. So we'll go through these rather quickly, but please, we will send this out and feel free to look through them in great detail as needed, because I know for myself that I really like to go through the mechanics to figure out the right accounting. So in a finance lease, lessee will, again, you're putting a right of use asset on the books on day one, and you're going to amortize that straight line. You do, because it's a finance lease, have an interest expense on the carrying value of the lease liability. You're going to reduce the carrying value of the lease liability as the lessee makes payments, and you're going to record variable lease payments, if any, in the period incurred, right? So that's kind of set up. Next slide. So the key here is, and the takeaway is in bold here, if you want to amortize the right of use asset over the lease term by the difference between the straight line lease expense and the lease liability accretion, and we'll demonstrate that for you. So let's jump in. So from a lessee perspective, on day one, you get a right of use asset, and that is calculated as initial direct costs incurred by the lessee, any prepayments of the lease payments, and subtracting any receipts of lease incentives. And then on the lease liability, you will do a net present value of the lease payments, discounted at, again, the way Grant described it, an implicit rate or the incremental borrowing rate. I just want to highlight that your right of use asset and your lease liability are not likely to equal on day one, right? And we'll go in through the mechanics and explain that, but they're going to be close. But for these additions and subtractions items, they most likely will not equal on day one. So let's go through an example. So this is a finance lease example. Background information, we've got a 3-year lease. We've already determined it is a lease. You've got lease payments as shown on the slide. And I want to note that there are $35,000 of initial direct costs, and we've identified a discount rate, called an incremental borrowing rate of 7%. So your day one right of use asset, as the math illustrates, 100K plus 105 plus 110 plus the IDCs of 35K gets you to an asset on day one of 350,000. So at left, you have the amortization straight line of the $350,000 balance that we just walked you through and how to get there. At right, you have the lease liability up in the box where it says $274,962. That is your net present value using a 7% discount of the lease to the lease liability on day one. And then you've got your payments going out 100,000, 105, 110. And again, you will eliminate said lease liability by year 3. And so a couple calculations. So in year 1, you've got interest expense. That is, again, calculated as 7% of the net present value of 274 on day 1. And you've got cash going out the door, credit of cash, 100,000, and your delta is really that 80,000 of which you're reducing your lease liability. And then again, the straight line expense on the right of use asset is 116K as demonstrated. So again, that's kind of a quick example, and I know I'm going quickly, but I think it's one that most people, they're familiar with a finance lease or a capital lease historically. This still gets them the same kind of mechanics. So moving on there. Continuing that example, just wanted to illustrate from an operational cash flow perspective. So I'm talking about the operating cash flow in year 1 is 54,000. That total is the sum of 19,000 interest plus the 35,000 of IDCs. And then of course your pay down of the lease liability of 80,000 goes to financing activities on a finance lease. And a total cash flows in year 1 of 135. Again, the $100,000 payment and 35,000 of IDCs. So just wanted to clearly illustrate the impact the cash flow statement. Given that this is a finance lease, the largest component is going to be found in your financing section of your cash flows. Again, interest being operating.
All right, and we have another polling question. Okay, and that question is popping up here. The lease liability recognized by a lessee at lease commencement is equal to which of the following? Fair value of the asset under the lease, present value of future lease payments, total undiscounted future minimum lease payments, none of the above, or I'm not sure. So we're going to give, again, a couple of a bit of a time here for all of you to register your answers for this polling question. This is important in order for us to provide you with CPE, and we are going to provide you a copy of these slides and a link to the recording within 48 hours of this presentation. Also, many of you have sent in some specific questions for our presenters, and we will get you out answers to those within 48 hours of today's presentation. So with that, we're going to go ahead and close the poll. And the most popular answer here is the present value of future lease payments.
That is absolutely correct.
We've got a very smart audience.
Yeah, quite the
today.
bright audience today, but that is correct.
We're doing Jeopardy now.
Yeah.
That is correct. Okay, so we have another quick example here on the operating lease. So again, same background information as the finance lease we just walked you through. A couple key calculations that are different for an operating lease. So again, the right of use asset calculated as the sum total of the payment streams plus IDCs gets you 350,000, which is similar to the finance lease as expected. And then there is this concept of accreting the liability based on the 7% discount rate up each in this example, annual period. and that's calculated as the net present value at the 7% discount gets you $19,247 in year one, and I'll illustrate this in a second. The right of use amortization in year one is $97,000. The key takeaway here is you take the straight line expense less the lease accretion, excuse me, to get the amortization on the right of use asset. And then we'll talk about cash flows, but for an operating lease, all operations based. So again, you have your lease cost, a debit of 116. You've got your right of use asset reduction at 97, which is again the delta between the accretion on the lease liability. And then again, once you've accreted said liability up, you take it down by that $100,000 payment and in year one and reduce your liability accordingly. So I know I went through that quickly, but I think these concepts and mechanics, if you on the phone look through them, I think they're pretty readily understandable in terms of the mechanics of doing a lessee lease, whether it be finance or operating. So I just wanted to highlight that there are a number of practical expedients available under the standard. We don't have enough time to go through them in great detail, but Grant and I felt it important to highlight that the FASB has recently voted to create a new optional transition method for lessees that would essentially limit the amount of a look back period that is required currently under the modified retrospective approach. I do want to highlight that when we say modified retrospective approach, if you've been thinking about that in terms of ASC 606 or the new revenue recognition standard, although they're worded similarly, they're accounted for differently. And I think a lot of people get confused on that. So currently under the lease standard, the modified retrospective makes public companies look back to the 2 preceding years, or in other words, the earliest period presented. And candidly, it can get very difficult in doing that, both to operationalize that and to do the look back. Again, not having used the practical expedients available can be very difficult. So the standard setters are getting smarter. I think, Grant, you and I talked about this. The vote was, I think, 6-1, but it yet has not
6
yet
to 1.
codified.
Yeah, my understanding is not a part of the official ASC 842 yet, but what I'm hearing is that it will be coming out soon and it will be part of the official codification. So definitely some relief for companies not having to go back and report 2 years of comparable data. So we'll keep you all posted once it hopefully does become official.
Yeah, that could be a large relief. So glad they're thinking about it. Hope that it comes to fruition. With that, we want to move on to the next slide. So this is where we really want to spend some time with you in the remaining part of the hour. I know we only have about 7 hours. So a lot of you who are listening in go, well, okay, I get the standard. I kind of follow the accounting, but what do I do, right? And so what we've listed here are some high-level actionable steps and want to talk through them. So maybe the first thing you want to do is assess your existing leases and their impacts on the business, right? You certainly want to update your lease inventory. So go out and look for leases that you have, that you're aware of, maybe some that you haven't thought of. Certainly start to assess risk, right? Is it a copy machine lease or is it our largest building? Those things have different impacts on your business and should be risk rated accordingly. The other thing that I wanted to highlight and talked about earlier is the examination of embedded leases. This is not to be overlooked. You want to look at your service contracts based on the nature of your business and really make sure that you have examined for your embedded lease, the potential for an embedded lease, and or made sure you've documented for your auditors that you have thought about this. And I can tell you from a number of conversations with clients of mine with their respective auditors, this is something that's very high on their list. They want to know that you all have looked for the embedded leases and not just took what your existing lease base was and translated to 842. So I think that's important. By way of, loosely identifying the impact on your financial statements. You all currently project, if you're a lessee, your 5-year footnote and disclosure, so payments thereafter. If you were to look at that and translate that to, okay, these were historically all operating leases disclosed this way, you might have a quick acid test to determine how much you might be putting onto your balance sheet just if you were looking at it simply that way. I think a lot of people look at it that and say, okay, well, I can go to my board, I can go to my investors, I can go, well, we've had X amount over the next 5 years, that translates to this much to my balance sheet as a quick test. And I think most people are receptive to doing that, and it gives them an idea of scale. The next is evaluate impact of financial ratios and metrics. I was meeting with a potential client yesterday, and I think this was rather very high on their list, specifically their debt to equity ratio. They're very well capitalized business, but at the same time, as they think about bringing on what were their very significant historical operating leases onto their balance sheet, whether that truly drives up their debt or just a liability, and what the impact potentially was on their covenant. So if you're not already talking to your vendor or your lenders, suggest you might think about doing it. I can tell you most banks and or traditional lenders are aware of this and are thinking about it. And from the covenants that I've seen, a lot of the banks have written in new GAAP or a change that will potentially accommodate, but they don't know what that means yet.
A lot of my clients are concerned about that as well, how the bringing on operating lease liabilities will impact their debt covenants. And the FASB has come out and stated that operating lease liabilities generally won't meet the definition of debt. Hopefully that alleviates some of the debt covenant concerns.
Absolutely. I'm going to move on to the next slide. So for those CFOs that are on the phone, we've worked out a couple of key questions that we believe you should ask yourself and ask of your organization. Certainly, thinking with risk in mind, where are my areas of risk? Is it real estate? Is it really nominal equipment? Is it that agreement that you entered into with that construction company that may contain a crane? You really need to think about it holistically and try to tease out what would be your risk areas. The next thing, again, inventorying your leases, but how many do we have? What's that volume look like? Once we identify it, can we get access to the data? Is it digitized? Are these in a file cabinet somewhere? How do I extract data? How will I recalculate under 842 the impact? Okay, do I need to change our business process and behaviors based on looking, do we want to restructure or think about drafting leases in the future differently? That's a change in behavior to get a desired outcome. The big one here is, do we need to implement applicable technology or modify existing systems? Certainly if you have a high degree of volume, and that could mean anything more than say 15, 20 leases, you know, there are many tools and solutions that may ease this process. Thinking with the end in mind, the deadline, how much time do I need to do this? When should I get started? Get ahead of it. When will resourcing be available to help us with this? Do I have qualified internal resources to help with this? Should we designate somebody to own this right now? Is that somebody internal or external? Have we talked to our auditors? Should we talk to our auditors? Do we know enough to even go talk to our auditors yet?
And your tax accountants as well, because this will have some implications on your tax positions.
Yep. So, and lastly, who are the right partners to help us? Certainly Armanino is here to help. Those of you on the phone, we would love to enter into discussions and talk about how we might assist in driving your 842 initiative forward.
All right, and in our last minute, we have one last polling question. So we want to make sure you get credit for your CPE. So last one should be simple to answer, and it is, how prepared is your organization for the new lease standard? So after hearing today's presentation, do you feel very prepared, moderately prepared, or not prepared at all? So we look forward to you entering in your answers there. And we are going to close the poll in just a couple of seconds, but we will move to our final slide, which will provide for you the contact information for both Grant and Justin. And as mentioned, we will go ahead and close that poll, and we will make sure that we respond to the individual questions that you sent out to us. It looks like the audience is feeling, you know, kind of in the middle here. Some are very prepared, most are moderately, and some need to get to work on their preparations before the deadline. So we've reviewed the key differences of the new lease accounting standard and talked about how it plays with the new revenue recognition standard. We've analyzed examples of how that standard could be accounted for by lessees and developed actionable steps for your organization to take in preparation. So thank you for joining us. Again, Grant and Lamb, thank you for this very informative webinar, and we appreciate you joining Armanino today.